The risk of loss trading any financial instrument can be substantial. You must be aware and willing to accept those risks in order to invest. Don't trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy or sell any financial interest. No representation is being made that any account is likely to achieve profits or losses similar to the ones discussed here. Past performance is not indicative of any future results. Any strategies discussed are for illustrative purposes only and are not to be construed as specific advisory recommendations. This material is for educational purposes only. Okay, we're going to get into day 2 on Binex 101. Today we're going to be talking about what is a pip, what is a bid ask, what is margin, what is leverage, what is a spread, what is a candlestick, what is a time frame chart, and what is rollover. Some of these things are very simple to explain, and some of the others may take a few minutes. So let's get started. First of all, I'm going to take a picture of my screen here so that I can write on it. Take a picture. Okay, here we go. This is a chart. The first thing we're going to be talking about is what is a pip. What is a pip? Do you see the prices over here on the right hand side? Everything except for the yen pairs moves out to the 4th decimal point. Everything, the yen pairs move out to the 2nd decimal point, for instance. If the EURUSD equals 130.05, this 5 right here is the pip. If it moves up to 6, that is a 1 pip move up. If it moves from 5 all the way up to 10, that is a 5 pip move. If it moves from 5 all the way up to 15, that is a 10 pip move. So every 4th decimal point on everything except for the yen pairs is a 1 pip move. If it moves from 130.05 up to 131.05, how many pips has it moved up? It's moved up 100 pips. Okay, now on the yen pairs, now I don't know why they do it this way, but this is the way they do it. On the yen pairs, let's see, 109.46 or 109.50. On the yen pairs, everything with a Japanese yen in it, the 2nd decimal point is the pip. So if it moves from 150 to 151, that is a 1 pip move. If it moves from 150 to 160, if it moves from 109.50 to 109.60, that is a 10 pip move. So everything except for the yen pairs goes out to the 4th decimal point. The yen pairs goes to the 2nd decimal point. Okay, what if I see something like this? It doesn't matter. The 2nd decimal point is a pip. The 4th decimal point is a pip. The 5th decimal point, it's irrelevant. That's a 10th of a pip. On the yen pairs, the 3rd decimal point is a 10th of a pip. It's, you know, even, I don't care if you see this. If you see a price like this, the only number that matters is that one, the number 5. That is the pip movement. All these other numbers are irrelevant. If you see something like this, on the yen pairs, the only number that is relevant is that one. So if it moves from 109.60, blah, 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 all this bunch of numbers, to 109.70, how much of a move has that moved up? It's moved up 10 pips. You can see that right there. If this moves from 131.05, 43, 42, well, whatever, all of that, and it moves up to 131.08, and it has moved from 5 to 8, it's moved up 3 pips. Okay, so the 4th decimal point on most currency pairs except for the yen, on the yen, it is the 2nd decimal point. Got it? Good. How much is a pip worth if price moves up or down by 1 pip? Well, on a typical mini lot, it's going to be worth about $1. Now, on every currency pair, where the USD is on the right, such as the Euro USD or the British Pound USD, it's always going to be worth $1 on a what you call a mini lot. But let's just think it's always going to be worth 1. Okay, if you are trading a micro lot, it's going to be worth 10 cents a pip. Can't type. It's going to be worth 10 cents a pip if you're trading a micro lot. 1 micro equals 10 cents per pip. 1 mini lot equals $1 per pip. 1 standard lot equals $10 per pip. That's the way it goes for every single currency pair that has the USD on the right side of the pair. That's how much they're worth, always. Now, what if the USD is on the left side, such as USDJPY or, I don't know, USD Swiss franc? Well, without going into too much detail, it's still going to be worth about $1. Maybe one of them is worth 90. Maybe the other one is worth $1.10. You know, some of them are worth a little bit more than $1. Some of them are worth a little bit less than $1, but they're all going to be right around $1. You know, for a mini lot. For a micro lot, this might be 90 cents. For a, I mean 9 cents for a micro. It might be 90 cents for a mini lot, and it might be $9 for a standard lot. This may be, you know, 11 cents for a micro lot, $1.10 for a mini lot, and $110 for a standard lot. Here's a test question for you. If price moves on the Euro USD from 130.25 to 130.37, how many pips is that? How many pips movement is that? I will give you a second. I can't type. Answer, 12 pips. It's moved from 130.25 to 130.37, and that is 12 pips. Now we're only using the last decimal here as our pip movement calculator. 130.25 to 130.37 is 12 pips. How many pips is the USD yen worth if it moves from 109.50 down to 109? $50 pips. From 50 down to 0 is 50 pips. Next topic. What is the bid ask? Now the bid ask, you see these numbers going up and down right here? These will move up and down. We're looking at a yen pair, so it goes out to the second decimal point, such as this 80 or this 81. The bid ask is where the market makers make their money. They make a market for you to trade in. Now it can be called the bid ask. It can be called the buy sell, or sell buy actually. Put call for binaries, or whatever you want to do it, but the majority of people use bid ask. All right, so what is the bid ask? Well, right here, let's look at this one right here. Now they will constantly move up and down. Right now, the price is 109.827. You can see that right here, 109.827 by 109.842. 109.842. Now, if you enter into a trade on this right here, you can buy this at 109.842. However, you are going to be down by a number of pips right off the bat. And here's how you do it. 109.842 minus 109.827 equals 1.5 pips. This is the spread. This is how the market makers make their money. As soon as you enter into a trade, you have to overcome that spread, which means if you're buying, it needs to move up by 1.5 pips before you make any money. When you place the trade, you are automatically 1.5 pips in the hole. Okay. If you are selling, you can sell this at 109.827. But if you're selling, you are automatically 1.5 pips in the hole. Now, if you will look right here, the live prices are constantly changing. They're constantly changing, and when the bid-ask moves up or down, these two spreads right here, this spread right here, will get narrower or wider. When more liquidity comes into the market, they will get narrower. When liquidity drops out, they will get wider. It will be more expensive. It is not uncommon around 5 p.m. in the afternoon to have a spread of 10.5 pips. You know why? 5 p.m. in the afternoon is when all of the banks are doing their recalculating and all of that, and nobody trades at that time, so the spread is wider, and that's how the market makers make their money. If nobody's trading, they're going to make more off of a 10.5 pip spread just for the risk that they are putting up. So that is what the bid-ask is. You can never buy a Forex pair with zero spread in the majority of circumstances. There are times when it happens in a fast-moving market, things like that. But sometimes you can buy it for 0.3 or 0.1. Sometimes, if you're using an ECN broker, you can have what's called positive spread, which means you can buy for lower than you can sell it for, and that causes arbitrage opportunities. However, they're very rare, and by the time you pull the trigger, somebody else has got it, so don't even think that you're going to make a trading opportunity there. Okay, so the spread is how the market maker makes their money. What is margin and leverage? You hear these terms all the time thrown around the Forex communities, and I'm getting ready to explain it really quickly. Okay, here's a picture of my house. Now, I'm just kidding. That's a nice house, though. Now, here's a picture of a house. Okay, let's say you want to buy that house, but you don't have the money to do that. The bank is going to allow you to use leverage to buy this house. Let's say this house is listed for $1 million. The buyer, let's say he doesn't have $1 million to buy the house, but he wants to buy it anyways. Well, he will go to a bank, and let's say he puts up $200,000 as a down payment toward this house. The buyer is using 5-to-1 leverage to control this house. He's able to move into this house, move his family in, do anything he wants to it by not putting up the full purchase price. He's putting up $200,000. Now the bank is going to charge him interest, of course, but he can control this house for less than the price of the house. Same thing in the Forex market. The buyer is using 5-to-1 leverage, which means it will take 5 of this down payment here to pay off the house, but he's able to control the house. Now, let's say the house value goes up from $1 million to $1,200,000. The buyer, he put up $200,000 to control the house, okay? But the house value just went up to $1,200,000. So if he wants to sell this, he put up $200,000, and now the house is worth another $200,000 more than the money that he put up. Okay, he just made a 100% profit on the money that he put up. He didn't put up all the money, but he made a 100% profit on the actual amount of money that he put up. Now, the amount of money that he put up, this is the margin that he put up, okay? Margin. Now, margin is the amount of money each trader must keep in his or her account to keep a trade open. What if you have a broker that has 20-to-1 leverage? Well, if you have 20-to-1 leverage and your account is $1,000, how much money can you control? You can control $20,000. If you can control $20,000 with only $1,000 in your account, then you are trading with 20-to-1 leverage. Now, if you're using 20-to-1 leverage and your account is $1,000 and you want to trade $20,000 worth of currency, then you're going to trade a 0.2 lot on average. 0.2 lot. A 0.2 lot is 2 mini lots. It's 20 micro lots, and it's 0.2 of a regular standard lot. It's 0.2. When you trade 0.2, how much is that in actual currency moves? Well, if 1 micro lot equals 10 cents per pip, 1 mini lot equals $1 per pip, or 0.10 equals $1 per pip, and 1 standard lot, 1.0, equals $100 per pip, then how much is a pip worth if you're trading 0.2? Well, you're trading 2 mini lots. 0.10 and 0.10 equals 0.20. You're trading 2 mini lots. That would equal $2 a pip. That's how much you're trading if you're trading two mini lots here. So let's say you're trading at $2 a pip. And you have a $1,000 account. And price moves up by 100 pips in your favor. 100 pips. How much money have you made at $2 a pip in your $1,000 account and price has moved up 100 pips? You have made $200. Not too shabby. Now, $200 on a $1,000 account is a 20% return, okay? However, if you're trading too large, such as I think this is, if you're trading too large and it falls against you by 100 pips, you're going to lose 20% of your account. This is how leverage works. Now, let's say you're trading with no leverage. You're trading with 0 leverage, 1-to-1. Your account is $1,000. Let me get rid of all this. Your account is $1,000. You're not going to trade with any leverage at all. And you're going to buy 1 micro lot at 10 cents a pip. How much now is it worth if it moves $100 in your favor, or 100 pips in your favor? $10. If it moves 100 pips down, you lose $10. Losing $10 is a whole lot better than losing $200 on a $1,000 account. Making $10 is a lot more reasonable than making $200 on a $1,000 account, for the simple fact that if you lose $200 and lose 20% of your account, you will be devastated. So watch out on your leverage. How much leverage do I trade with? I trade with 5-to-1 leverage max. From time to time it may be 6-to-1 or whatever, but this is about what I trade with. So the maximum, if you traded with 5-to-1 leverage, what could potentially be your returns? On a $1,000 account, trading 5-to-1 leverage, that's 50 cents a pip. A 100 pip move would be $50. $50 from $1,000 is 5% of your account, win or loss. Okay, so that's margin and leverage. Here's the big E. What is a margin call? A margin call is when you're trading too large for your account and price just goes way against you and they shut the trade off because you have no more margin left in your account to help keep that trade open. You never want to get a margin call. It's very horrible when you do. I've got margin calls before. So always make sure there's enough money in your account to trade. Okay, what is rollover? Now, you remember me telling you a few minutes ago, at 5 p.m. every day, the spreads get really wide? Well, one of the reasons is this is when rollover is calculated. At 5 p.m. every day, you will be paid or deducted a rollover fee. This is the difference between the two currency interest rates that you're trading. And that's only if you hold it at 5 p.m. If you hold it till 4:59 and then get back in the trade at 5:01, you will not be paid or deducted this fee. And if you hold over the weekend, they're going to either pay you or charge you for 3 days. The basic way that they come up with it is they take the interest rates. Let's take the USD, the New Zealand US dollar right here, 0.5 and 2.25. Well, if you are, let me write this down. Basically, if the New Zealand dollar has a yearly interest rate of 2.25 and the USD has an interest rate of 0.5, and you're long the New Zealand US dollar, that's 1.75% per year. Now, what they do is they take this and they divide it among all the days, 365 days, and that small microscopic amount of that interest rate is what you get paid or deducted from your account, every day at 5 o'clock. Now, if you are trading with no leverage, then it's not going to be very much. But if you get into trading with leverage, it can be quite a lot. There used to be a great strategy. It was called the carry trade. Now, what people would do, they would pick a currency that had a very high interest rate. I think Australian dollar a few years ago was up to like 8%. And then they would pick a currency that had a very low interest rate, and then they would just ride that trade out all year long and collect those interest fees every day at 5 p.m. The carry trade does not work that great in the current market conditions, so you can go look that up. Okay, so we've talked about what is a pip, what is bid-ask, what is margin, what is leverage, what's a spread, and what is rollover. Now we're going to be talking about a couple of things on the chart. What is a time frame chart and what is a candlestick? Now what you see here is just a chart. It's a chart, and it goes up and down. You can look at different styles of chart. There's a candlestick chart. Here's a bar chart, there's line charts, and all kinds of charts. However, the one that I like the most is a candlestick. It's the best visual representation of price that you can see. It's called a candlestick chart, and that's what I use. Now, there's different time frames on a chart. What we're looking at right now is a 5-minute time frame. You can also see different time frames, such as, let's say, the 1 hour time frame. Each bar is going to show 1 hour that's passed in time. If you look at a daily time frame, you can see each bar represents 1 day of movement. Each one of these bars represents 1 day. Now, if we're looking at the very last day right here, which is today, and we go down to the 5-minute chart, you can see throughout the day what has happened, and you can see it on a shorter term scale. So when you're looking at a longer term chart and the movements they don't look very big, well, they can be hundreds of pips. Like this bar right here, from top to bottom, was 291 pips. It doesn't look like it because it's on a daily chart. The smaller time frame you get down to, the less likely the movements are going to be huge. If you get down to a 1 minute time frame and it looks like a really big movement, from here to here, it's only 42 pips. If you saw this on a daily chart, a big movement that took up the entire screen, that's more like, let me get it, 1,300 pips. So there's different time frame charts that you can look at to show you all kinds of different information. I believe we have covered enough in today's video. We will come back tomorrow or in the next couple of days with how does one currency affect one another, how do traders take advantage of trading opportunities, what are the profit and loss potentials of Forex, what are indicators and why are they useful, and beware of scams. That's what we will talk about in the next episode. All right, thank you, and I'll see you guys later. Bye-bye.